Welcome to the deep dive, where we really try to get under the skin of the stories behind the numbers. We aim to give you those essential insights you need to, well, stay truly informed. Today, we're zooming in on Aeon Credit Service, or Aeon NCR. It's a company that really seems to be standing at a crossroads, doesn't it?
It certainly feels that way.
On one hand, you've got the stock, which has taken a bit of a beating lately, signaling, some immediate pain. But on the other, management is betting big on this, well, quite visionary living zone ecosystem. So if you've been keeping an eye on AEONCR, you'll know its share price is hovering around RM 4.88 today. That's September 4th, 2025. And that's a pretty noticeable 13% drop over just the past 6 months.
Yeah, that definitely catches your attention.
It really does, and it raises a lot of questions. So our mission today is to unpack the most important insights from their latest financial report. That's the Q1 FY2026 one, dated July 8th, 2025. And then we want to dive into their strategic moves and what the future might hold. We're really going to try and give you a foundational understanding of what's really happening here, sort of setting the stage for what comes next.
And, that foundation is absolutely crucial for you listening. This Q1 FY 2026 report, it serves as our critical baseline. It paints a picture of where Aeon NCR stands right now. And with the Q2 FY 2026 report expected later this month, late September, this deep dive will perfectly prepare you for when we do a follow-up analysis.
Exactly.
We'll be able to compare the challenges, the strategies we discussed today with their latest progress when those new numbers come out. So, yeah, get ready for a thorough but hopefully accessible exploration of not just the numbers, but the pretty compelling narrative behind AEONCR.
Okay, let's unpack this then, starting with their Q1 FY 2026 headline performance. What immediately jumps out, at least to me, is this kind of paradox. You've got strong top-line growth, but then, a significant hit to the bottom line. How do we start making sense of that?
Yeah, what's fascinating here is precisely that divergence you've pointed out.
Yeah.
It immediately signals there are underlying challenges hitting profitability, even though the operational momentum looks, pretty robust. So on one hand, Aeon Credit reported a healthy 14.9% year-on-year increase in revenue. That reached almost RM 600 million, RM 599.92 million to be exact, for the quarter ending May 31st, 2025.
Okay.
That's a very strong top-line performance. It shows they can still attract new business and expand their financing activities.
That revenue growth, it does sound like a genuine silver lining, doesn't it? I mean, they're still clearly expanding their reach, growing their loan book. That's often seen as a positive sign for a financing company. Can you maybe elaborate a bit on what's driving that growth?
Absolutely. And that strong revenue, it wasn't just, a one-off. It was backed by some pretty solid underlying operational metrics. Their transaction and financing volume was up a robust 13.9% year-on-year. That hit RM 2.249 billion.
Wow.
So that shows an active customer base and, successful origination of new financing. And furthermore, their gross financing receivables, that's the total amount owed to them before any provisions for bad debts, that grew by an impressive 15.6% year-on-year, reaching RM 14.63 billion. So this reflects continued, pretty strong loan and financing growth. And importantly, it signals their market penetration and consistent demand for their products, even in an environment where, as they've said, they've been tightening credit assessments.
Right.
So yeah, the top line is definitely, you could say, firing on all cylinders.
Okay, so on the revenue side, things look good. They're successfully growing the portfolio, but you mentioned that hit to the bottom line. How significant was this? I mean, how sharply did profits actually fall despite that impressive revenue growth?
Yeah, the profit plunge was, unfortunately, quite dramatic. Net profit for Q1 FY 2026 plummeted a staggering 27.1% year-on-year.
27%, wow.
Yeah, it settled at just RM 77.55 million. Now, to put that in perspective, for every dollar of revenue they generated, significantly less actually made it to the bottom line compared to the previous year. Their profit before tax, or PBT, also saw a really substantial decline, 24.7% year-on-year, settling at about RM 109 million.
Okay.
So this isn't just, a little bump in the road. It really exposes a fundamental vulnerability. For a consumer finance company, one that's heavily reliant on certain customer segments, a profit drop of this size, especially when revenue is strong, it forces a critical look at their risk appetite, their business model. It immediately tells us that even though they're bringing in more money, something significant is eating away at their profitability.
Yeah, that 27.1% drop in net profit, that's definitely, a flashing red light for any business, isn't it? So what exactly is causing this stark contrast between the healthy revenue growth and such a sharp profit plunge? Where did the money go?
Well, the primary drag by far was the soaring impairment losses on financing receivables.
Okay, impairment losses.
Right. These are essentially the funds a lender has to set aside to cover potential losses from loans that, well, customers are struggling to repay. In Q1 FY2026, these surged dramatically. They hit RM 229.4 million.
Wow, 229 million.
Yeah, and to give you some context, that's a really substantial increase from RM 163.457 million in the same quarter last year.
Right.
And management explicitly attributed this surge to, and I'm quoting here, poorer collections and higher than expected write-offs. That directly points to, increasing financial stress among their customer base.
That's a truly huge jump in impairment losses. So basically, customers are finding it harder to pay back their loans, and that forces AEONCR to allocate significantly more funds just to cover potential defaults. What does that actually do to their overall cost structure?
Precisely.
Really,
And this directly impacts a critical indicator of, well, deteriorating asset quality, their net credit cost.
Net credit cost, okay.
Yeah. This metric expanded significantly. It went up to 4.98% in Q1 FY 2026. That's a really sharp rise from 3.2% year on year.
So almost 5% now?
Almost 5%. And for a financing company, a near 5% net credit cost isn't just a statistic. It translates directly into needing higher provisions. It puts strains on liquidity, and it signals potential, maybe even systemic stress within their loan book that frankly demands immediate intervention. This big increase in credit costs also drove up their overall operating expenses. The ratio of total operating expenses against revenue increased to 68.5% in this quarter. That's up from 63.5% a year ago. And it's primarily driven by these higher impairment losses. It's a clear signal that the cost of doing business, specifically the cost of lending, has gone up significantly, and it's overriding any efficiency gains they might be making elsewhere.
Okay, so rising credit costs from struggling customers, that's the main culprit, really hammering the bottom line. But I also remember hearing about Aeon Bank, their digital bank venture. How's that playing into this profitability puzzle? Is that also a drain on earnings right now?
Yeah, that's the secondary, but still, significant drag on their profitability. Yeah. Aeon Credit share of losses from its digital bank associate, Aeon Bank, increased by 37.3% year on year.
Okay.
It came in at RM 15.9 million for the quarter. That's up from about RM 11.6 million in Q1 of the previous year. Now, it's important to note this is largely in line with what management guided. They guided an annual loss of around RM 60 million for the digital bank during its initial growth phase.
Right, startup costs, essentially.
Exactly. Launching and scaling a digital bank, it's a capital-intensive exercise. Early losses are pretty much expected as they build the infrastructure, attract customers, develop products, all that stuff.
So these losses from the digital bank are, well, somewhat anticipated as part of a long-term investment, but they're still eating into the current profits. Is there any early indication that Aeon Bank is actually starting to generate some revenue, or is it still purely in that spending phase?
Yeah, there are some encouraging signs on that front, actually. Despite the losses, Aeon Bank did record an income of RM 2.6 million in Q1 FY 2026.
Okay, that's something.
It is. And management described its revenue pipeline as encouraging. They launched a personal financing product back in March 2025, which is generating some income, and they have plans to offer credit facilities to merchants soon. So while it's definitely a drag on current earnings, it's clearly building towards future revenue streams. But, this raises that important question again. How sustainable is this overall growth if it's accompanied by such a steep increase in credit costs? The digital bank is a strategic long-term play, aiming for future success. But right now, it's a measurable drag on current earnings. It's that classic trade-off, isn't it, between pursuing aggressive growth, managing the inherent risks, and making these crucial future investments for long-term strategic advantage. AEONCR is, well, navigating a very challenging balance right now.
Yeah, that delicate balancing act between growth and risk, it's clearly right at the heart of their current challenges. And speaking of risk, with those credit costs soaring, how is AEONCR actively managing its loan book? Are we seeing a broad deterioration in asset quality? And, what are their defenses against more bad loans?
Well, this is where their asset quality and risk management really come under the microscope. Their non-performing loan, or NPL ratio, did increase. It went up to 2.57% as of May 31st, 2025.
Okay, 2.57%.
Yeah, which is up from 2.46% a year earlier. Now, while it might seem like a marginal increase for a financial institution, any upward trend in NPLs signals a slight deterioration in the overall health of its loan portfolio. It confirms more customers are falling behind. However, it's also worth noting that this 2.57% is actually a slight improvement from the 2.64% recorded at the end of the previous fiscal year, February 28th, 2025.
Oh, interesting. So a slight tick down from the end of last year, but still up year on year.
Exactly. And management has explicitly stated that, quote, corrective actions have been taken to address the NPL ratio increase, indicating they are aware and, actively responding.
Okay, management says they're taking corrective actions, and maybe that NPL increase looks marginal year on year, but isn't any deterioration in asset quality a pretty significant red flag for a lender? How much comfort can we really take from those reassurances, given the trend, especially with those rising impairment losses?
You've hit on a really crucial point there. For any lender, rising NPLs are always a concern, regardless of the size of the increase. They indicate stress among borrowers, and they can be a precursor to higher write-offs if they're not managed effectively. However, it's not the only metric we should look at. Despite that NPL increase, Aeon Credit maintains a very robust loan loss coverage ratio.
Loan loss coverage, okay.
Right. This ratio stood at a pretty healthy 217% as of May 31st, 2025.
217%.
Yeah. Now, that's marginally lower than the 222% recorded a year prior, but this figure is still a strong indicator of financial prudence. What it means is, for every RM 1.00 of non-performing loans they have, Aeon Credit has RM 2.17 in provision set aside.
Okay, so more than double coverage.
Exactly. It demonstrates a very strong buffer and a conservative approach to potential losses, which is absolutely crucial in the current sort of uncertain economic environment. It's a critical safety net that cushions the impact of those deteriorating NPLs on their capital.
The 217% coverage certainly sounds like a solid safety net, buys them some breathing room. What specific proactive measures are they taking beyond just monitoring to manage this increasing risk and hopefully, reverse these negative trends?
Yeah, they're definitely not just sitting back and watching. Management is actively tightening credit assessments and loan approvals across the board. They're particularly focusing on younger and lower income borrowers who are, well, unfortunately, more vulnerable to economic pressures like inflation, rising costs of living, potential job market volatility, things like that.
Right.
And this isn't just a vague directive. It involves, recalibrating their proprietary credit scoring algorithms, perhaps raising minimum income thresholds, or even adjusting loan tenures and amounts for profiles they deem higher risk.
So getting more granular.
Very much so. For younger borrowers, this might mean a more rigorous assessment of stable employment, maybe a phased approach to credit limits. And these stricter underwriting measures are, according to the company, already showing early signs of improved repayment collections.
Okay, that's encouraging.
It is. It's a positive first step. Furthermore, in a move that shows, I think, real prudence in risk management, they also preemptively booked an additional RM 14 million in general provisions.
General provision, okay.
Yeah, so this isn't tied to specific identified bad loans. It's more of a buffer against anticipated macroeconomic headwinds, preparing for potential future shocks. So if we connect this back to the bigger picture, you've got a healthy loan loss coverage ratio combined with these proactive measures. It demonstrates strong financial prudence. However, the true test, the real proof, will be if their corrective actions and tighter assessments effectively reverse that NPL trend and bring down credit costs meaningfully in the coming quarters, without, of course, stifling necessary growth.
Right, that's the balancing act again. It's clear AEONCR is, well, fighting fires on the asset quality front with those proactive measures. But earlier we touched on Aeon Bank being, a drag on profits right now, yet part of this larger, much more ambitious long-term vision. What exactly is this Aeon Living Zone, and how does the digital bank fit into this grander integrated scheme?
Yeah, here's where it becomes really clear that Aeon Bank's primary long-term role isn't just to operate as a standalone digital bank, competing head-on with traditional banks. Instead, it's designed to be the financial cornerstone, the digital payment and lending engine of a much larger integrated digital ecosystem known as the Aeon Living Zone.
Aeon Living Zone.
Right. This is a vision to unify and enhance the entire customer experience across the whole Aeon group in Malaysia, from their retail stores to their financial services. Think of it not as building a new bank in isolation, but more like laying a superhighway of data and services within their existing retail empire.
That sounds incredibly ambitious, aiming for synergy across the entire Aeon family. What's the formal structure behind this living zone, and which entities are the key players in actually bringing it to life?
Well, it revolves around a strategic joint venture, a JV, that was formalized between Aeon Credit, they hold a controlling 51% ownership, and Aeon MBHD, holding the remaining 49%.
Okay, so a formal JV.
Yeah. They started this new entity with an initial paid-up capital of RM 50 million. And the JV's core purpose is to drive the integration of customer membership, data intelligence, and digital engagement across the entire Aeon ecosystem in Malaysia.
Yeah.
And this isn't just a couple of companies. It involves Aeon retail stores, Aeon big supermarkets, Aeon Credit itself, and Aeon Bank all working together through this unified platform.
Wow.
The operations for this JV are expected to commence relatively soon, too, by the fourth quarter of 2025.
That's a pretty significant undertaking, bringing together so many different arms of the business. And for such a complex integration, what's the anticipated timeline for actually seeing the financial benefits, those early gains from this Aeon Living Zone?
Yeah, it's definitely a long-term play. It requires patience and, frankly, sustained investment. The managing director, Daisuke Maeda, has been quite clear about this. He anticipates that, quote, early gains from this integrated strategy will materialize about 3 years after its launch.
3 years post-launch. Okay.
So yeah, this isn't a quick win. It's a carefully planned, multi-year strategic build-out designed to, well, future-proof the entire Aeon brand. It highlights that while the current losses from the bank are a drag, the strategic value is seen as substantial over that longer horizon.
Given that long-term horizon, what exactly are Aeon Bank's integral functions within this unified ecosystem? How does it serve as the official bank and drive the digital strategy?
Right, so Aeon Bank will serve several critical functions within this new structure. Firstly, yes, it will be the official bank for this new JV entity, acting as the central financial hub. Crucially, it's designed to drive digital innovation and data-driven growth by leveraging unified customer data from the entire Aeon group.
Okay, leveraging that data.
Exactly. This means they'll gain, theoretically, a 360-degree view of customers, enabling them to offer more relevant and timely financial products. And this expands beyond just personal financing, which they launched in March 2025. They plan to include credit facilities and business banking solutions for merchants and partners within the ecosystem soon. The ultimate goal here is to facilitate a holistic retail and financial experience, making interactions simpler, more rewarding across all their touchpoints, from shopping at Aeon retail and e-commerce to accessing financial services.
That makes perfect sense for the long-term strategic vision. But for now, as we've discussed, Aeon Bank is still a drag on Aeon Credit's current profits. Can you just remind us of the financial relationship between Aeon Credit and Aeon Bank, and maybe quantify that drag again for our listeners?
Certainly. So Aeon Bank is classified as an associate of Aeon Credit. This means Aeon Credit holds a significant but not controlling stake. It's 51% in the JV itself, but Aeon Bank is a separate entity where Aeon Credit has influence. This stake is recorded as an investment in an associate on Aeon Credit's balance sheet. It was valued at RM 174.2 million as of May 31st, 2025. Now, while this investment represents a relatively small percentage of Aeon Credit's total assets, just 1.2% of their RM 14.76 billion total assets and 6.1% of its total equity, RM 2.88 billion. That RM 15.9 million loss from Aeon Bank in Q1 FY2026 was equivalent to a notable negative 20.5% of Aeon Credit's net profit of RM 77.5 million.
Wow, over 20% impact on net profit.
Exactly. So it clearly indicates a significant financial drag on short-term profitability, even if it's considered a strategic investment. But here's where it gets really interesting, potentially. This JV, it truly unlocks potential ecosystem synergy. The long-term plan isn't just about having a bank, it's about accessing this vast, interconnected customer base. Mr. Maeda highlighted a key opportunity. Aeon Credit's current customers are mainly from the B40 income group. Aeon Co.'s retail customers, however, are predominantly M40. And there's apparently very little overlap between the two.
Oh, okay.
Different customer segments.
Right, so this integrated Aeon Living Zone app could be an incredibly powerful, low-cost cross-selling tool. It allows Aeon Credit to diversify its customer base away from those most vulnerable segments, although, as we noted, it will take years to fully mature and yield significant financial returns.
That's a really critical detail, that potential to diversify their customer base, which could, theoretically, reduce their exposure to economically sensitive segments over time. Now, let's talk about the stock itself. The share price, as we said, has dropped 13% in 6 months, sitting at RM 4.88 today. Is the market simply overreacting to these immediate challenges, or are these declines justified? Basically, is AEONCR undervalued at its current price? What are analysts saying?
Well, the consensus from analysts is pretty clear. Aeon Credit does appear quantitatively undervalued, especially when you look at the traditional metric.
Okay, undervalued quantitatively.
Right. However, this low valuation directly reflects the significant market concern over its immediate challenges, specifically that deteriorating asset quality and the ongoing pressure on profitability that we've been discussing. The market isn't blind to the long-term potential of the living zone, but it's heavily weighing the current headwinds and, frankly, the execution risks involved. It's a classic case of looking cheap for a reason.
So the numbers suggest it's cheap, but the market's saying, hang on, we need to see proof of concept and execution first. How does AEONCR actually stack up against its peers in the non-bank financial institution or NBFI sector in terms of key valuation metrics? Are these discounts truly significant?
Yeah, let's delve into some key metrics, using Kananga Research's comparison as a guide to understand the depth of this discount. First, the one-year forward price-to-earnings, or PR ratio. Aeon Credit is currently trading at about 8.1x.
8.1x PER.
Right. The sector aggregate, on the other hand, is significantly higher at 13.3x.
Wow, that's a big gap.
It is. That's a discount of nearly 40%. This tells you the market is clearly pricing in the projected negative earnings growth for FY 2026, which is forecasted at negative 3.8%. Investors are expecting that dip in earnings, and the PER reflects that skepticism.
A 40% discount on PER is certainly eye-catching. What about its price-to-book value, the PBV ratio?
Yeah.
That often gives a good sense of how the market values the company relative to its underlying assets.
Yeah, on the one-year forward price-to-book value, or PBV ratio, Aeon Credit stands at a mere 1.0x.
1 times book.
Just 1 times book, versus the sector aggregate of 2.2x. This is a very telling metric. It means the stock is trading almost precisely at its net asset value per share, which was RM 5.63 as of May 31st, 2025. In contrast, its peers are trading at more than double their book value. This significant discount suggests a lack of market confidence in Aeon Credit's immediate ability to generate strong returns on that equity. It indicates investors don't believe the company is efficiently utilizing its assets to create shareholder value right now.
Those are indeed significant discounts compared to its peers, highlighting the market skepticism. What about its ability to generate returns for shareholders, the ROE, and its growth prospects compared to the sector? Are these also lagging?
Unfortunately, yes, they are lagging currently. On return on equity, ROE for 1 year forward, Aeon Credit's forecasted ROE is 12.3%. That's notably lower than the sector aggregate of 16.6%. And its annualized ROE for Q1 FY 2026 was even weaker at 10.9%, falling short of its own 12.0% target. For core earnings per share, EPS growth 1 year forward, Aeon Credit is projected at minus 3.9%, while the sector aggregate is facing a slightly less steep decline at minus 1.9%. So yes, it's projected to face a tougher near-term earnings environment. However, there is a glimmer of hope in the forecasts. Analysts do project a strong rebound of 23.4% for the following year, the 2 year forward.
Okay, a potential rebound later on.
Right, suggesting some confidence in a future recovery, perhaps once the current issues are addressed or the digital strategy starts paying off.
That potential rebound is interesting. Finally, for income-focused investors, what does the dividend yield look like, especially given the current stock price and those sector comparisons?
Well, for income-focused investors, there is indeed an attractive element here. The 1 year forward net dividend yield is quite compelling. It's projected at 5.0% for Aeon Credit.
5% yield.
Yeah, compared to the sector aggregate of 3.9%. So it definitely stands out for those looking for income. It suggests that even with the current challenges, the dividend might be a stabilizing factor, or maybe a reason to, as analysts say, accumulate on weakness.
So it sounds like a bit of a mixed bag then. Quantitatively discounted valuation, a comparatively good dividend yield, but weaker near-term profitability and growth compared to peers. What's the overall analyst sentiment? What's the target price, especially given these recent challenges and the lowered forecasts?
Well, Kananga Research, for instance, they have a target price of RM 6.25, though it's worth noting this was recently lowered from RM 7.0.
Okay, lowered but still suggesting upside.
Exactly. Despite the reduction, they maintain an outperform recommendation. That implies an expected total return of more than 10% from their target. From the current price of RM 4.88, that suggests a potential upside, roughly 28%. Now, the rationale for lowering the target price was precisely because of those higher-than-expected impairment losses in Q1 FY 2026. Analysts consequently raised their net credit cost assumptions for FY 2026. They bumped it from 3.5% to 4.0%, for FY 2027 from 3.4% to 3.6%. They also lowered their assumed ROE from 13% down to 12% in their Gordon growth model valuation. And all this resulted in a 13% cut in their FY 2026 earnings forecasts and an 8% cut for FY 2027.
Right, so direct impact from Q1 results.
Direct impact. So what does this all mean for you listening? The market is definitely pricing in that near-term earnings weakness. The significant discount in PER and PBV clearly suggests a lack of confidence in immediate profitability.
Right.
However, that outperform rating and the attractive dividend yield, particularly for investors willing to look through the short-term volatility, suggest a tale as two horizons for Aeon Credit. High risk in the short term, absolutely, but potential long-term upside for those who believe in the strategic pivot and the eventual recovery. It's a compelling proposition, perhaps, but definitely one for those with a longer investment horizon.
That's a really clear picture of the market's current assessment. And it certainly sounds like management has its work cut out for them, doesn't it? Navigating these immediate headwinds while simultaneously trying to build out this ambitious Aeon Living Zone ecosystem. How are they planning to tackle these tough times in the short term? And what's their bigger, say, 5-year plan for future growth?
Yeah, management is definitely taking a sort of dual-pronged approach. They're focusing on immediate firefighting while strategically laying the groundwork for the future. In the short term, they're maintaining a very cautious business stance. They're keenly aware of all the external pressures, ongoing global trade uncertainties, geopolitical tensions, inflation, volatile financial markets, all things that directly impact their customer base. And to respond to those rising impairment losses we discussed, they are actively tightening credit assessments and loan approvals, especially, as we noted, for younger and lower-income borrowers who are just more susceptible to these economic pressures.
Right.
This involves, recalibrating their credit scoring algorithms, adjusting loan terms, being more selective.
So it's really about tightening the belts and focusing on quality over sheer volume, even if they still have a growth target.
Exactly that. They're prioritizing growing quality assets and closely monitoring inherent credit risks, despite still officially maintaining a 10% loan growth target.
That's an interesting tension there.
It is. How do you grow significantly while also being more selective? Their approach seems to be refining customer acquisition channels and focusing on segments that show better repayment behavior historically. They're also continuously enhancing their IT capabilities. This actually led to a slight improvement in their cost-to-income ratio, if you exclude credit costs, in Q1 FY 2026. That focus on operational efficiency is crucial when profitability is under pressure elsewhere. And crucially, the managing director, Daisuke Maeda, he stated that while Q2 is still challenging, from Q3 and Q4, our performance will be better. That suggests confidence in a second-half recovery driven by these proactive measures starting to show results.
That confidence in a second-half recovery is definitely something we'll be watching for very closely. Now, let's look further out. What about the long-term vision, this Aeon Living Zone that's expected to deliver gains in about 3 years? How does that shape their strategic direction over, say, a 5-year horizon?
Well, for the long term, that 5-year horizon is really all about digital transformation and ecosystem synergy. The Aeon Living Zone is absolutely at the core of that. The vision is to future-proof the brand by creating this intelligent membership ecosystem. And the cornerstone, as we discussed, is that new JV with Aeon Co. MBHD, set to start operations in Q4 2025. This JV will act as a unified orchestration layer, bringing together customer data and membership across Aeon Retail, Aeon Big, Aeon Credit, and Aeon Bank into a single integrated platform. Imagine perhaps a single app or digital identity for all your Aeon interactions.
That sounds like a potentially powerful tool for customer engagement, loyalty, and, crucially, cross-selling across their vast ecosystem. How does this integrated strategy translate into expanded customer reach and more effective cross-selling for Aeon Credit specifically?
Precisely. The JV aims to unlock what they call true ecosystem synergy. It provides a potentially very low-cost channel to cross-sell financial products to Aeon Co.'s predominantly M40 customer base. And this is a crucial strategic move because, as Mr. Mehta pointed out, Aeon Credit's existing customers are mainly B40 with little overlap. This move aims to significantly diversify their customer portfolio away from the most vulnerable segments, reducing their concentration risk and potentially improving overall asset quality in the long run.
Right, reaching that different demographic.
Exactly. And Aeon Bank will serve as the JV's official bank, providing business banking solutions and strengthening the group's commitment to data-driven growth. As mentioned, early gains are expected maybe 3 years after launch, emphasizing that long-term commitment and the significant investment in future growth. So it really shows this powerful dual approach. Immediate firefighting with tighter risk management and a clear focus on asset quality, while simultaneously laying critical groundwork for potentially profound long-term strategic growth. The success of the Aeon Living Zone is the big bet for future-proofing the business. But it absolutely requires patience and, frankly, flawless execution, given the complexity of integrating multiple entities. It really is about widening that economic moat for the decades ahead.
Widening that economic moat, that's a perfect segue. Every truly great company has an economic moat, right? Something protecting its business from competitors, giving it a sustainable advantage. What are AEONCR's unique competitive advantages, those strengths that protect it? And importantly, where are its vulnerabilities or weaknesses in that moat, especially considering its current challenges?
Yeah, Aeon Credit definitely has some strong, quite entrenched elements to its economic moat, which are critical for its long-term survival and success. One of the most significant strengths is undoubtedly its deep integration with the broader Aeon retail ecosystem. That synergistic relationship with Aeon retail stores, Aeon big supermarkets, and now Aeon Bank creates a captive customer base and a powerful cross-selling platform. And the new JV we just talked about, it aims to formally strengthen this true ecosystem synergy, making it even harder for competitors to replicate.
So leveraging the existing brand, the physical presence, now adding this integrated digital platform, that's a huge plus. What about its customer base itself? How does that contribute to its moat? And what's the strategic play with the Aeon Living Zone here?
Exactly. Another strength is its expansive and hopefully increasingly diversified customer base. They already have a large established base, historically around 65% B40, 35 M40. But the JV is specifically designed to systematically cross-sell to Aeon Retail's M40 customers, that segment with little overlap. This move expands their reach and diversifies their exposure, making them less reliant on a single demographic and potentially reducing risk concentrations over time. And beyond just familiarity, the Aeon brand itself in Malaysia carries decades of accumulated trust, particularly with its core customer segments.
Yeah, it's a household name.
It really is. And that's not just about a logo. It represents a perceived reliability and accessibility that's invaluable in financial services. This trust translates into customer stickiness and probably a lower cost of acquisition compared to new entrants who have to build credibility from scratch. The Living Zone isn't just about digitizing. It's about leveraging this existing reservoir of trust to transition customers seamlessly into a digital ecosystem. It protects this significant intangible asset from disruption and, future-proofs it for a generation that increasingly expects digital-first experiences. And lastly, they have a pretty well-developed digital and operational infrastructure already. Their continuous IT enhancements and their instant approval process support efficient operations and sales momentum. And this is a key asset they bring to the new JV, enabling potentially rapid execution of the digital strategy.
Those sound like truly formidable strengths, deeply embedded in their business model and brand. But every moat has its weak points, doesn't it? Especially in a dynamic market. Where are Aeon Credit's key vulnerabilities or weaknesses that could be exploited by competitors or macroeconomic factors?
Well, the Achilles heel, as it were,
Yeah.
and what we've seen directly impacting them in Q1 is its high sensitivity to macroeconomic conditions.
Yeah.
Its heavy reliance on the B40 segment, even with diversification efforts underway, makes it highly vulnerable to inflation, rising costs of living, trade uncertainties, you name it. We saw this directly in Q1 with those higher impairment losses and the preemptive booking of that RM14 million in general provisions. Shows how quickly external factors can impact profitability, highlighting a structural fragility perhaps in their current loan book.
So their core customer base, while large, is also a bit of a double-edged sword.
Yeah.
A broad market, but also very exposed to economic shocks. What other vulnerabilities exist in their competitive landscape or structure?
Precisely. Then there's the intense competition in consumer financing. While the sources don't name specific competitors, we know the market is crowded. You've got other NBFIs, traditional banks getting more involved, emerging fintechs all vying for market share. Also, their dependency on associates' performance, specifically Aeon Bank, is a current weakness. While strategically crucial for the future, the digital bank's current loss-making status, that RM15.9 million loss in Q1 FY2026, directly impacts Aeon Credit's profitability right now and weighs on metrics like ROE. This means a significant chunk of their earnings is, for now, at the mercy of another entity's performance trajectory. And finally, there's that loan growth versus asset quality dilemma again. They're constantly balancing their 10% loan growth target with tightening credit assessments. While tightening is prudent, it could slow growth and potentially concede market share to less cautious competitors, highlighting a fragility during economic downturns. So, yeah, this gives us a pretty clear picture. The core strength is undoubtedly the Aeon ecosystem and brand, which is now poised for a digital leap with the Living Zone. That strategy, if executed well, could significantly broaden and deepen its moat. However, the Achilles heel remains its exposure to economically sensitive customer segments, making it highly susceptible to macro shocks. And the digital bank, while a long-term strategic play, is a definite short-term drag that truly tests the moat's resilience right now.
That's an incredibly comprehensive look at their competitive landscape and strategic positioning. Now it's time for our signature financial scorecard. We're going to grade AEONCR on 6 key areas from 1 to 10, just to give you a quick, holistic overview of its financial health and performance. How did they score? What are the key takeaways from each category?
All right, let's break down Aeon Credit's performance with our scorecard. This should give you a clear snapshot of their strengths and weaknesses right now. Okay, first up, revenue and loan growth. I'd give them a strong 8 out of 10.
8, okay. Pretty good.
Yeah, the strength here is very clear.
Right.
Strong and consistent momentum. You've got that 14.9% revenue growth, 15.6% gross financing receivables growth year-on-year in Q1 FY2026. And management reports loan growth remains intact at about 10% year-on-year, showing healthy demand. However, the weakness, and it's a critical one, is that this strong growth is currently overshadowed by that deteriorating asset quality. This challenges its sustainable contribution to profitability, making us question the quality of that growth, perhaps.
So they're successfully bringing in the business, but at what cost to their bottom line, which brings us nicely to profitability. What's the score there?
Exactly. For profitability, I'm giving them a relatively low score here, a 4 out of 10.
Sir? Ouch.
Yeah. Look, the underlying business operations, if you strip out the credit costs, are indeed profitable as a foundational positive. But the weakness is significant. Net profit plummeted 27.1% year-on-year to just RM 77.5 million in Q1 FY 2026. This was primarily driven by that sharp increase in impairment losses, the RM 229.4 million, and also the RM 15.9 million share of losses from Aeon Bank. The annualized return on equity for Q1 was also lower at 10.9%, falling short of their own 12.0% target and well below the sector average. So yeah, this is a major concern right now.
A tough score there, definitely reflecting the immediate pain. Next, how did they fare on asset quality and risk management? Given those impairment losses, I'm expecting some challenges here too.
For asset quality and risk management, I'm putting them at a 5 out of 10.
5, okay, middle of the road.
Kind of. On the strength side, they do maintain that healthy loan loss coverage ratio of 217%. That provides a strong buffer against potential defaults. Management is also taking proactive steps, tightening credit assessments, preemptively booking that RM 14 million in general provisions, showing prudence. The weakness, however, is that key metrics are deteriorating. The NPL ratio increased to 2.57% year-on-year, and the net credit cost expanded significantly to 4.98% year-on-year. So while they're taking action, the trend itself is still concerning.
Moving on to the bedrock of any financial institution, their balance sheet and solvency. How robust is their financial foundation looking?
For balance sheet and solvency, solid 7 out of 10.
7, better.
Yeah. Their net assets per share are steadily growing, reaching RM 5.63 as of May 31st, 2025, which indicates increasing intrinsic value. Their capital adequacy ratio, CAR, was a strong 21.05%, signifying solid capacity to handle potential losses and support future growth. The weakness, however, is that the CIR is on a bit of a downward trend. It was 24.44% a year ago. Now, while 21% is still strong, this reflects that rapid balance sheet expansion and requires monitoring to ensure it doesn't fall below comfortable levels. Borrowings have also increased naturally in line with receivables growth, which is expected but does add leverage.
And in terms of how efficiently they're running things, their operational efficiency score, are they making the most of their revenue before those credit costs hit?
For operational efficiency, also a 7 out of 10. They've shown strength in improving their cost-to-income ratio, excluding credit costs, slightly. It went down to 33.9% from 34.5% year-on-year. This indicates effective management of their core operating expenses. They also consistently focus on IT enhancements to streamline processes. The major weakness, though, is that the overall ratio of total operating expenses, which includes those soaring impairments, to revenue increased to 68.5%. This clearly shows just how much those credit costs are overwhelming efficiency gains elsewhere and impacting their overall operating leverage.
Finally, for the investors listening, what's the verdict on investor returns and valuation? Is it a good time to consider the stock given all the challenges?
For investor returns and valuation, I give them a 6 out of 10. The strength is that it offers that attractive projected forward dividend yield of 5.0% to 5.3%, which is notably higher than the sector average. And it appears quantitatively undervalued, trading at that low PER of 8.1x and a PBV of 1.0x, both significantly lower than sector averages. The weakness, of course, is that near-term earnings forecasts are negative, with EPS growth projected at monocle 3.8%. And analysts have cut FY 2026 earnings forecasts due to the weak Q1. So while it looks cheap and offers income, the immediate earnings picture is definitely challenging.
So what does that all add up to then for an overall financial score for Aeon Credit, taking all these factors into account?
Based on these factors, you're looking at an overall financial score of 6 out of 10.
6 overall.
Yeah. In summary, Aeon Credit is really a business in transition. It's facing significant macroeconomic headwinds that are pressuring both profitability and asset quality. Its inherent strengths in revenue generation and a generally robust balance sheet are currently overshadowed by these credit impairment challenges and the drag from its digital bank investment. Management is taking prudent steps to address these issues, and the long-term Aeon Living Zone strategy is genuinely promising, but it will undoubtedly take time and flawless execution to materialize. The stock offers an attractive dividend amidst this near-term earnings volatility, making it, well, a nuanced proposition for investors.
A 6 out of 10 overall score, that indicates some real challenges, as you've clearly highlighted. But for many investors, especially maybe in this kind of market, dividends are a major draw. Can Aeon Credit keep rewarding its shareholders with those attractive payouts, especially given the current profit pressures and that drag from Aeon Bank?
Yeah, that's a critical question, isn't it? Particularly for income-focused investors who might be looking at AEONCR precisely because of its yield. Now, for Q1 FY2026, the quarter that ended May 31st, 2025, no dividend was proposed or declared. But this is typical for the company.
Okay, normal practice.
Right. Dividends are usually announced semi-annually or annually, so it's not a cause for immediate alarm just based on this quarter. However, looking ahead, analysts are forecasting a quite attractive forward net dividend yield for the full FY 2026, somewhere between 5.0% and 5.3%. This is notably higher than the NBFI sector average of 3.9%, making it quite appealing if that yield can be sustained.
So the projected yield is strong, indicating analyst confidence? Maybe. But how confident can we be about them maintaining it, given that recent profit drop and the increased impairment losses? What does their payout history and future projections suggest?
Well, the forecasted dividend per share, or DPS, for FY 2026 is around 30.80 and is projected to increase slightly to 34.80 in FY 2027. Now, this is based on an assumed payout ratio of 40%, which is consistent with what they did in FY 2025.
Okay, 40% payout.
Right. And historically, they've shown a commitment to dividends with a slight but steady increase. FY 2025 saw a total dividend of 28.75 per share, which was up just slightly from 28.25 in FY 2024. This historical trend is important because it establishes a precedent, a track record for prioritizing shareholder returns.
That historical commitment and the projected yield sound promising, at least on paper. But what are the concrete risks that could potentially derail this dividend sustainability, especially with the immediate pressures on profitability we've seen?
Yeah, the main risks stem directly from that pressure on profitability we've discussed so much. That surge in impairment losses to RM 229.4 million in Q1 directly caused the 27.1% drop in net profit. If these high credit costs persist, they will continue to erode the earnings base that's available for dividends. That would force management to either reduce the payout ratio, maybe below 40%, or even cut the absolute dividend amount. Right. Macroeconomic headwinds are also a big factor. Their vulnerable customer base, 65% B40, 35% M40, is highly susceptible to inflation, rising costs of living, economic slowdowns. This could potentially lead to higher defaults, which would further fuel impairment losses. The losses from Aeon Bank, that RM 15.9 million share of losses, also directly reduce net profit and therefore the pool of funds available for dividends. And of course, if management's expectation of a stronger second half of FY 2026 fails to materialize, that 40% payout ratio commitment could become very challenging to maintain without straining their capital.
Those are definitely significant headwinds that could certainly challenge their dividend policy. But you mentioned management's confidence earlier. What makes you think Aeon Credit can continue these dividends despite all these risks? Is there a strong commitment there to maintaining shareholder returns?
Well, there are strong indicators that they will prioritize this, likely because it's such a key part of their investor appeal. First and foremost is that strong management commitment we heard. Managing Director Daisuke Maeda explicitly expressed confidence that Aeon Credit can maintain its dividend payout for FY 2026 despite the weak start. That public statement is a powerful signal to the market, indicating clear strategic intent. Their confidence seems based on an expectation of recovery in the second half. driven by those proactive measures like tightening credit assessments, which they say are already showing early signs of improved repayment collections. End quote. If those measures translate into lower credit costs, it directly supports profitability and makes the dividend easier to afford. Furthermore, they do have sufficient capital. They maintain that healthy CR of 21.05% and steadily growing net asset value per share, RM 5.63. This strong balance sheet provides a buffer to absorb short-term profit fluctuations without immediately jeopardizing dividends. And lastly, that attractive dividend yield is a key investor appeal. It's a crucial part of the stock's value proposition, encouraging investors, perhaps, to accumulate on weakness. Management knows that cutting it would severely impact sentiment and their ability to attract long-term investors. So, this highlights a fascinating tension for you as a listener. On one hand, profitability is under severe pressure right now. On the other, management is clearly prioritizing dividend consistency.
This commitment, backed by a solid balance sheet and an expected H2 recovery, suggests they'll likely try very hard to hold the line on dividends for FY 2026. However, any investor should closely monitor NPLs and credit costs going forward, as these are the ultimate arbiters of dividend sustainability in the longer term. Hashtag #TED10. Challenges, risks, and red flags.
We've covered a lot of ground today, looking at the numbers, the strategies, the competitive landscape, the dividends. Let's try and pull it all together now. What are the biggest immediate challenges, the longer-term strategic risks, and maybe most importantly, what specific red flags should we all be watching out for with AEONCR as we move forward?
Okay, the immediate challenges are quite stark, and they're directly impacting their short-term performance right now. The most pressing is undoubtedly that deteriorating asset quality and the rising credit costs. We saw impairment losses surge to RM 229.4 million in Q1, leading to that 27.1% net profit drop, explicitly due to poorer collections. Their net credit costs expanded significantly to 4.98%, signaling acute financial stress, and the NPL ratio increased year-on-year to 2.57%. This translates directly into severe pressure on profitability. You've got the plummeting net profit, the sharp decline in the PBT margin down to 18.2% from 27.7%, and that declining ROE of 10.9%, below target and below the sector average. And all of this is exacerbated by those macroeconomic headwinds. Their customer base, 65% B40, 35% M40, is highly vulnerable to inflation and rising living costs. This has led management to acknowledge Q2 will still be challenging due to these external factors.
So it's a really tough environment directly impacting their core business right now. What about the strategic and longer-term risks, the things that could affect their ambitious plans for the Aeon Living Zone and future growth?
Yeah, on the strategic front, the financial drag from their digital bank investment is a key long-term risk to watch. Aeon credit share of losses from Aeon Bank, RM 15.9 million in Q1, RM 68.3 million for all of FY 2025, directly reduces net profit and weighs on ROE. While these losses were somewhat expected, prolonged or escalating losses would become a more significant burden than perhaps initially planned. Beyond that, there's significant execution risk with the whole Aeon Living Zone ecosystem. It has a long time horizon for games, remember, maybe 3 years after launch. Unifying data and membership across 4 distinct entities, retail, big, credit, bank, is a profoundly complex technological and operational challenge. Success is absolutely not guaranteed.
Right, huge integration task.
Huge. And finally, there's that inherent conflict again, balancing growth with asset quality. While they target 10% loan growth, they're simultaneously touting credit assessments. This means they face a constant dilemma. Slowing loan growth could impact top-line revenue, but being too aggressive on growth could further compromise asset quality. It's a delicate tightrope walk that requires really precise management.
Those are definitely substantial risks, both short and long term. For our listeners who are keen to monitor AEONCR's progress, what are the specific red flags, the warning signs that we should all be watching out for in upcoming reports that would signal perhaps deeper problems?
Yeah, there are 5 key red flags that I think you should absolutely be monitoring closely. First, watch for continued high net credit cost. If that 4.98% figure doesn't start to decline meaningfully in the upcoming quarters, Q2, Q3, it signifies persistent customer financial stress and maybe ineffective risk management. That's a critical indicator of their core business health.
Okay, net credit cost is number 1.
Number 1. Second, failure to meet revised profit forecasts. Analysts have already cut FY 2026 forecast by 13%. Missing these lowered expectations, especially if that projected second-half recovery doesn't materialize, would signal deeper problems than currently anticipated by the market. Third, further deterioration of NPL and loan loss coverage ratios. Any further significant increase in the NPL ratio, currently 2.57%, or a continued noticeable decline in the loan loss coverage, currently 217%, would be a serious concern, eroding their safety buffer. Fourth, keep an eye on the downward trend in the capital adequacy ratio, CAR. It dropped from 24.44% to 21.05% year-on-year. While still strong, a continued significant decline could constrain their future loan growth or their ability to absorb unexpected shocks. And fifth, watch the losses from Aeon Bank. If those losses accelerate significantly beyond the guided RM60 million annual loss, it becomes a much more significant and prolonged drag on earnings, potentially impacting the overall strategic rationale or timeline. This raises an important question. Is management's confidence in a second-half recovery truly justified? Or is it perhaps an optimistic outlook in what is genuinely a tough operating environment that might stretch their resources further than anticipated? The sheer number of these red flags needs to be taken seriously, particularly the escalating credit costs and the market's clear reaction to them. It will really be a testament to management's ability to execute on their strategic initiatives amidst these very strong headwinds. #11, top 5 catalysts for next 2 years, upside and downside.
All right, let's look to the future now. We've outlined the challenges and the red flags, but what are the key factors, both positive and negative, that could truly move the needle for AEONCR over the next 2 years? What are the top 5 catalysts, maybe, that you and I will be keeping a very close eye on?
Okay, the most critical catalyst, I think, and it's truly a double-edged sword, represents both significant upside and downside, is the normalization of credit costs and asset quality.
Right, getting that under control.
Absolutely. On the downside, if we see persistent high net credit costs, like that 4.98% we saw, and impairment losses stay elevated, like the RM 229.4 million in Q1, it will continue to suppress profitability for a prolonged period. It could even threaten the sustainability of their dividend payout eventually. The upside, however, is substantial. If their tightened credit assessments and proactive measures successfully stabilize asset quality, leading to those early signs of improved repayment collections, translating into a real reduction in credit costs back towards historical norms, well, that would directly boost net profit and potentially lead to a significant re-rating of the stock by the market. This is absolutely foundational.
So getting their core lending business back on a stable track is paramount for their financial health. What's the next big catalyst, particularly relating to that ambitious digital strategy we talked about?
Second, the execution and early integration of the Aeon Living Zone JV is a huge potential upside catalyst. This joint venture, 51% Aeon Credit, 49% Aeon Co., is set to commence operations in Q4 2025, unifying data and membership across all Aeon entities. If they achieve a successful launch and, crucially, get some initial adoption from customers, this could provide a truly low-cost channel to cross-sell financial products to Aeon Co.'s largely untapped M40 customer base. This represents a significant long-term growth story, diversifying their portfolio, reducing risk concentration, even if the full financial gains from this ecosystem play take a few years to fully materialize. Early success would be a very positive signal.
And the digital bank, Aeon Bank, which has been a drag so far, could also pivot and become a major catalyst itself, right? Its performance seems crucial to that whole ecosystem.
Absolutely. The third catalyst is the performance of Aeon Bank itself. The digital bank is a key part of the Aeon Living Zone, but it's currently a drag on earnings. Remember that RM 15.9 million loss in Q1. On the downside, if its losses accelerate beyond the guided RM 60 million annual loss, or if its product launches fail to gain significant traction, it will continue to weigh heavily on Aeon Credit's earnings and maybe investor sentiment about the strategy. The upside, however, is better than expected performance. Faster income generation like that RM 2.6 million income in Q1 may be growing faster and narrowing losses. This would reduce the drag on Aeon Credit's P&L and provide crucial validation of the overall digital strategy's viability sooner rather than later.
Okay. What about the broader economic environment? It sounds like that will remain a significant external factor, perhaps mostly beyond their direct control.
Indeed. The fourth catalyst, and this is primarily a potential downside catalyst, is macroeconomic conditions and consumer health. As we've highlighted repeatedly, Aeon Credit's customer base, 65 or 40, 35% M40, is highly sensitive to economic shifts. A further slowdown in the Malaysian economy or prolonged, sticky inflationary pressure over the next 2 years would almost inevitably lead to higher default rates, increased NPLs, currently 2.57%, and sustained high credit costs. This would directly undermine that expected second-half recovery and put immense pressure on their profitability targets. Management explicitly maintains a cautious business stance because of these very real external risks.
Right, a constant headwind potentially. Finally, what about the investor perspective and that attractive dividend we discussed earlier? Can that also serve as a powerful catalyst one way or the other?
Yes, absolutely. The fifth catalyst is investor confidence and dividend sustainability. Aeon Credit's projected dividend yield of 5.0%, 5.3% is a key appeal for many investors right now, especially given the low valuation. Managing Director Daisuke Maeda's explicit confidence in maintaining the FY 2026 dividend payout, if backed up by an actual earnings recovery in the second half, could solidify investor trust. This would act as a strong upside catalyst, making the stock highly attractive for income-focused investors who might be looking to accumulate on weakness, believing in the long-term story despite the short-term turbulence. Conversely, any wavering on that dividend commitment or a failure of the H2 recovery to materialize sufficiently to support it would severely damage sentiment and likely trigger further selling pressure. Here's where it gets really interesting for you, the listener. The next 2 years will be a truly crucial test of management's ability to navigate this storm while simultaneously building their long-term fortress. It's a very delicate balance of tactical defense and strategic offense. So, as you consider Aeon Credit, maybe ask yourself this.
Is the market currently offering a valuable opportunity? A chance to buy into a long-term strategic transformation at what looks like a significant discount, betting on management's ability to execute this ambitious Aeon Living Zone vision? Or are the immediate challenges, particularly those escalating credit costs and the ongoing drag from Aeon Bank, simply too severe right now to warrant accumulation on weakness? Does this suggest a longer, perhaps bumpier road to recovery than currently hoped for? This deep dive hopefully provides the map. But the journey ahead, particularly with that Q2 report just around the corner, demands your careful monitoring of those key metrics, especially credit costs and any early signs of that ecosystem synergy actually working.
And that wraps up our deep dive into Aeon Credit's Q1 FY 2026 report and its future trajectory. We've tried to lay a solid foundation for understanding what's truly happening behind the numbers, the strategic moves AEONCR is making, and the crucial factors that will likely shape its journey over the next couple of years. We'll definitely be keeping a very close eye on the upcoming Q2 report later this month. And you can bet we'll do another deep dive then to check in on their progress and see if those early signs of improved repayment collections really do translate into a stronger second half. If you found this deep dive valuable today, please do hit that like button. Leave us a comment with your thoughts or any questions. We genuinely love hearing from you. And make sure to subscribe to our YouTube channel so you don't miss our next deep dive. Thanks so much for listening, and we'll catch you next time on the deep dive.